The year 2012 has been characterized with a lot of waves forcing a slow economic pace in Uganda. The banking sector has had multiple difficulties manifested through high interest rates on private sector loans and a reduction in performing loan rates. The negative performance was an after effect of high interest rates and reduction in real economic growth. The industry non-performing loan rate increased from 2% to above 4%, though still lower on the continent, but a bad signal to the country's acceptable rates. Despite such bad experiences, the banking industry generally remained annually profitable, but retained the profits within the bank's budgets, increasing the industry asset base to 2.6 trillion Uganda shillings by September this year. This is a representative of 600 Uganda billion shillings, an increment in a year's time. This, according to the central bank, makes the country's bank industry more resilient to any looming internal and external economic shocks, such as the current Eurozone, as well as the supply and demand shocks.
The banking industry holds sufficient capital to give it a high degree of resilience against future shocks.
There is need to stimulate the real economic growth through improved private sector lending. It is therefore important for commercial banks to reduce interest rates on loans and also diversify their bankable products and services to suit the clientele demand and expectations.
I hope that commercial banks will be able to continue to lower their lending rates to stimulate the recovery of loan demand from the private sector.
A recovery is, however, expected in the next 12 to 18 months, according to the Governor Bank of Uganda, through stimulation of lending to the private sector at a cost-effective rate. Nankwanga Kasiri, NBS Television, Business.